Ducati in Formula One. All of that and more coming up for you, but let's start with our top story tonight. The Reserve Bank today raised rates by 0.25%, but in an unusual step said the probability of future rate hikes is low. Now, relief stock markets gave the governor a thumbs up, but some believe the RBI's credentials as an inflation fighter have come under question. Gopika Gopakumar and Lata Venkatesh get us the highlights of the Reserve Bank's policy as was unveiled today.
The likelihood of a rate action in the December mid-quarter review is relatively low.
This unusual bout of commitment from the RBI governor was the most important feature of the policy. For the moment, however, he has raised the repo rates since inflation at 9.7% is still way above RBI's comfort level of 5%.
Both inflation and inflation expectations remain high. Inflation is broad-based and is above the comfort level of the Reserve Bank. We expect these levels to persist for 2 more months.
The policy has retained the March-end inflation forecast at 7%, largely because of the base effect. But the key change in this policy is the RBI's angst about growth, which it expects will fall to 7.6% from the earlier 8%.
The mid-quarter review of September, however, pointed out that the risk to growth projection was on the downside. Based on the current and evolving macroeconomic situation, we have revised the baseline projection of GDP growth for 2011-12 downwards to 7.6%.
The biggest criticism that economists have against the policy is its commitment not to hike anymore.
This is hardly transparency. I mean, central bankers form policy on what's likely to happen, but what could happen. And today the likelihood of reaching a 7% inflation is almost next to impossible. So this is more like a hip shooter's policy. Giving a commitment sort of a thing goes against every norm of central bank policy making. What if inflation doesn't subside by then?
The governor says he needed to give that stability since growth was falling.
We also have to be sensitive to the moderating growth. So we wanted to give some comfort, some sense of where we would be going to the market participants, particularly investors, so as to manage their expectations, in the hope that they will now plan their investments on a more predictable market situation.
Industry and bond markets have naturally welcomed the commitment, while the stock markets gave the governor a big thumbs up for this promise of stable interest rate environment.
I think the RBI has finally recognized that it's not an inflation targeter, that it has growth and employment both as its objective that it has to achieve.
While the concern on growth is welcome, a question rises over RBI's lack of concern on inflation.
And finally, an interesting math. The Reserve Bank says it expects inflation to come down to 7% by March end. That will work out to a WPI index number of 160. The September inflation number was 155.8. At this rate, the Reserve Bank expects inflation to increase by 0.9 points every month for the next 6 months, that is by 0.5% every month. Clearly, it doesn't expect the momentum of inflation to come down. Inflation is coming down to 7% solely because of the base effect. In spite of it, the Reserve Bank says that it is not going to raise rates any further in all probability. Going by this math and by the statement, it does appear that the Reserve Bank's commitment to bringing down inflation genuinely is not very high. In Mumbai with Gopika Gopakumar, Lata Venkatesh.
So after hiking rates 13 times, maybe, just maybe, the RBI could enter pause mode in its December policy. But the Finance Minister Pranab Mukherjee says that the Reserve Bank's latest round of rate hikes, which is aimed at curbing price rise, will also have some impact on economic growth.
I do hope the decision of R.B.I. to enhance the repo rate and reverse repo rate by 25 basis points would have its impact on inflation. Of course, it would have some impact on growth also, but the situation is difficult, and in a difficult situation we cannot expect to have a simple solution.
Well, that's the Finance Minister commenting on the Reserve Bank's policy, pretty much standard stuff. Now, the expectation was 25 basis points, and that's exactly what happened. But the other big highlight of the policy today was the fact that the Reserve Bank created a new chapter in bank liberalization. Remember, CNBC-TV18 had broken the story a short while ago. The Reserve Bank today has deregulated savings rate, and you can expect your savings to earn more, but the cost of a check leaf, as also of a home loan, will go up. Gopika Gopakumar and Lata Venkatesh try and understand what this really means for you and me.
Your savings deposit rates could rise from the current 4%, but sometime later they could also fall. The R.B.I. today deregulated these rates. Some bankers say that since savings deposits cost less than term deposits, it will be tempting for banks to offer higher rates to lure low-cost customers.
It is reasonably clear to me that at this stage in the current interest rate environment, the customer will get a higher savings rate than what he is or she is currently getting. So from a customer point of view, the rates I think will move up.
I think banks will factor in what is the real cost of a savings bank account. So don't just look at the 4%, but there is a huge transaction cost to a savings bank account, and our model really shows that a savings bank today really costs anything between 5 and 7% depending on the bank. It would be commercially not sound for any bank to give a savings bank rate which is more than the stabilized 90-day fixed deposit rate.
However, big bankers like SBI's Pratip Chaudhary say that since most banks have enough funds now, he is not expecting savings bank rates to rise anytime soon.
No, I think we are not in a hurry. We'll see how it plays out, because even otherwise today, large value saving depositors are moving into the sweep accounts for the fixed deposits. So we do not think there are enough customers out there who are using saving bank only for the yield. They are using saving bank for convenience. So unless there are other competing pressures, as of now the saving bank rate with SBI would continue where it is, that is 4%.
Bankers may be living in denial over savings rates. Yes Bank has already offered special 6% savings rate products. And big banks like SBI and HDFC may eventually have to fight to keep their depositors. The R.B.I. has put in some caveats. It has said that the same rate should be given to all deposits up to 1 lakh. Also above 1 lakh, similar amount of deposits should get the same rates. Big banks are also hoping to compensate what they lose by way of higher deposit rates by charging more for services like checks and ATMs.
Clearly, the banks are also a commercial organization. We have to raise money from the capital markets. So we will, as Mr. Chaudhary said, we will examine. And yes, you can, as they used to say about the interest rates, there is a definite upward bias on charges.
Separately, bankers say they are not sure lending rates will rise despite the repo rate hike because demand for credit is low. So while your savings rates are going up, maybe your term deposit and EMIs won't go up anytime soon. Finally, R.B.I. also said at the policy conference that banks have agreed to stop prepayment penalties, and if they don't,